Hello, hello, hello. Thank you for joining us on Inside North Carolina Real Estate for January 2026. I'm Terrence Boykin with Boykin Realty, powered by Keller Williams, covering the Triangle area of North Carolina.
And I am Donald Smith with Broker Smith at North Group Real Estate, covering southeastern North Carolina.
Zeke Fingleton here with VA and Real Estate Advisors, brokered by Compass, covering the Charlotte region.
Awesome, guys. And it is kicking off 2026. And I know all of you buyers and sellers out there have been hearing about interest rates, 50-year mortgages, affordability, all that good stuff. So we wanted to have our buddy Ryan Smith on today to talk to us about just that. Ryan's my trusted lender. He's going to tell us all he knows about finances today.
Okay. Hey, gang. Hey, I'm Ryan Smith, usual of Omaha Mortgage. Just to give you a little bit of background, I have been a mortgage loan originator in the state of North Carolina since 1997. So I'm about to kick off my 29th year of doing mortgages. So I think that makes me uniquely qualified to talk about anything mortgage related.
Ryan, the big thing I want to ask you about that we heard so much about, well, I did at least, at the end of 2025 was the possibility of a 50-year mortgage. Can you break that down for us? And is that really something that's going to come up?
Is it something that'll come up under the current administration? Maybe. I think we've all been battling, as I've quoted mortgages over the last almost 4 years now, with these much higher interest rates, these payments are just like really big, right? The prices of homes in general have not gone down, and they're not expected to go down. But basically, it's just ideas that are rolling out. Like, how can we combat this? What can we do? It's sort of the same as when we heard about car loans that went past 60 months. When they started introducing 72 months and then 84 months. And, if you actually had somebody at the finance table there at the car dealer break it down for you, it doesn't drop that payment as much as you would think. And I just did a real quick example for this call. If you were taking out a $400,000 mortgage, and I'm just going to use 6.25 as a rate that's generally available right now, on a 30-year loan, that payment would be $24.62 a month. That's just principal and interest. If you were to take the same interest rate and stretch it out another 20 years, it would make the payment $21.79, which is a reduction of $282 a month. Now, I don't know about you, but I'd love my payment to be $282 less. But the downside being I've got to pay that loan 20 more years. That seems like a tough hill to climb. If you look at the big picture, if you just take that payment and multiply it times 360, or the smaller payment and multiply it times 600, you're either going to pay $866,000 for the shorter, $1.3 million for the longer term. And when you look at it that way, if you're only borrowing $400, but you're going to pay an extra $441 in payments to go to the 50-year, really not a great idea.
Ryan, that's one thing I would like for you to repeat, because I know most of our buyers don't understand what you just said about how much, even in a 30-year loan, that if you were in that home for 30 years, which most of us aren't, but if you were, how much interest you would pay. So if you would say that one more time, on a $400,000 loan over 30 years, how much would you pay in interest?
Well, you're going to pay total in payments $866,633, but you borrowed $400, so you got to pay that back. So you're going to pay $466,000 in interest on top of the $400,000 of principal that you're paying back.
That's a big amount. And also, Ryan, you said on that 50-year, if they did do 50-year, it would probably be a higher interest rate, wouldn't it?
For sure. It's no difference in car terms, right? The shorter the term, the better the rate. And no difference in going from a 30-year mortgage to a 15-year. That rate's always going to be lower on a 15-year. So it would be a higher rate. So in actuality, you're not going to save $282 a month. It might be just closer to $200 or $225 a month.
Got it.
That's many years just to.
Yes, it is.
Oh my goodness! It would make. That's just hard to digest.
Yeah, and when I'm pre-qualifying people, it's generally a matter of is it a dual wage earner or dual earning household or single earner? And it's always easier if there's two people getting a paycheck versus one. So I think a lot of times we need to be thinking about more about the complete household formation before buying a house at today's prices.
Yeah. And Ryan, I don't hear many people, and my clients, not many of them go for it. I'll probably have 5 a year that do a 15-year loan. To me, that makes a lot of sense. And, with the word affordability, that seems to be the people that are most prepared and can truly afford not only that home, but everything else that might come up around that home if they're willing to take out that 15-year loan. So that's something I really want people to think about.
And I'd be willing to bet that if you saw it 5 times a year, probably all 5 of them are your move up buyer where they've got a massive down payment where they're buying a house and they're putting down 50% or more. And they're like, yeah, I don't want to have this big debt hanging over my head until I'm dead. I want to get it paid off.
Yep, exactly.
And that's usually when I see it as well.
Got it. All right.
Hey, Ryan, when would there be a moment that a 50-year mortgage would be a good fit for a buyer?
Well, I never say never. I've never taken out a car loan past 60 months, but in some instances, it might make sense. And, for example, Fannie Mae's chief economist, has said that they predict that home appreciation will be 20% between now and the end of this decade, like 20% from where we were at the start of the year. So if the home was going to appreciate 20%, I would rather go ahead and buy it now, even if I needed to go to a longer term, if it was available, just knowing, okay, once my income rises a little bit more, and if rates come down a little bit more, maybe I look to refinance to a 30-year or 20-year, et cetera.
I have a question as well on just a 40-year loan, because on some of the calls I've been on, I've heard people say that there are 40-year loans right now, and it seems like they're not offered up front, but really for people that may have been in trouble with their loan. Do you have any experience with that or can talk about that?
I have no experience with it whatsoever. Fannie Mae and Freddie Mac are going to be your conventional loans, and then you got your government loans. None of those are offered on a term beyond 30 years. Unless it's trying to keep somebody in their home that's in trouble, right? And the options are foreclosure or extending that term. So there's nobody applying for a mortgage and going to a 40-year mortgage term on a qualified mortgage. That's just not a thing. So there might be some, non-QM, non-qualified mortgage product out there for 40 years, but I have not seen one.
Getting off the total payment period of the loan, what are you expecting this year for interest rates? Because that's the biggest thing we get. What are the rates? I'm waiting to sell my house till the rates get here. I've got this rate. What are you expecting for 2026?
So that's a great topic. Last year in 2024, all through the month of August and into the month of September, mortgage rates kept going down. They were going down really nicely. And then the Fed's like, man, we got to do something to cut rates because we see this job market deteriorating. They cut rates 50 basis points or 0.5%. When they did that, mortgage rates went up. And so now there's just this thought process, because it's happened several times since then where the Fed cut rates and rates went up. And, I think there's a whole lot of dynamics around Fed rate cuts that don't have anything to do with that one singular thing. So if we feel like we're printing more paper in the U.S., if we got more debt than we can handle, that's causing the bond market rates to get higher, which is causing our mortgage rates to get higher. But we're in a really good spot right now in rates. They came down in September, then the Fed cut rates, and rates bumped up a little bit, but they only went up a little bit, maybe like a 1/4 point. And now they've kind of come back down, and we're almost at the lows for the year right now. And then going into 2026, I feel like the pathway is set for the rates to continue to trickle down. If they get to a 5 handle where I'm saying, hey, your normal 30-year conventional mortgage is 5.875, I think there's going to be a lot more demand in the market where people have been stuck. They've been stuck with their 3% interest rate. Are like, I got a couple of grand, 100 grand equity now. I don't want to be in this house anymore. I can mentally accept a 5 handle on the mortgage. I feel like that's going to be the thing that helps us. And I feel like it's going to get there. Just a matter of, do things stay stable where it stays there for an extended period?
Now, are you saying you feel like it might get there, that 5 number, in 2026?
Yes.
Wow,
Yes,
that's
I
a
do.
good sign. And I agree with you. I've talked to a lot of people, and that dropping from 6 to 5, even if it's 5.995 or 5.999, I think that is going to make a big difference in the market. What about you guys in Wilmington and Charlotte?
For us on the coast, we've got two different groups of buyers, right? You have your locals that have been here their entire life that have a household income that is significantly lower than those that are moving in from up north, the transplants that are coming. And so for one group that are local, it's going to make all the difference in the world because they're limited on what their income is. Those groups they're coming in with a cash reserve, and I'm not real sure that it's going to make a difference for them as much as it is for our locals here in this.
Yeah, and yeah, here in Charlotte, I think it's a lot like Ryan said, in that I work more so on the listing side, and so trying to convince the seller to sell, they're definitely asking, well, there's no way I'm gonna get my 3%, or some are less than that, right? So, um, but I do believe that with that mindset that Ryan was speaking of, that they can mentally say, okay, let me let me utilize my equity. When I'm talking to sellers, I'm actually talking to them about selling their home using their equity as another investment vehicle within real estate, that is. But my whole thing is to, you know, if there's some equity there, to put it towards another property, even an investment property. So I like Ryan's thought process.
Donald mentioned that first time buyer. Ryan, what are some strategies and how do you get game plans for that first time buyer? Because I know I just had you reach out to a young lady that you and I have been working with, I think for about 4 years now. I know it's at least 3. She was in a position to buy, I think in 2022, 2023. But at that time, houses were flying off the market at higher prices than they should have been. Then she had some, life started life, and now she's working to get back into the market. What's some of your words of advice for those first time home buyers out there?
Well, most of the time with the first time home buyers, the biggest obstacle is just not having the cash for the down payment. That's the number one thing that I run into. I've been very successful of using the North Carolina Housing's down payment assistance to help cross that gap, cover that gap. I'm doing usually 1 to 2 North Carolina housing loans every single month.
And what's involved in that, Ryan, just so that people know?
So really it's just using the normal, same old conventional or FHA loan you would always use. So where you need a 3 or a 3.5% down payment. And the folks in North Carolina Housing are giving us $15,000 to help cover that down payment. And then whatever's left over goes towards the buyer's closing costs.
That's a big help for a lot of buyers because that first time buyer, they're looking at a purchase of depending on where they are in the state, from 150 to really 325. So that's a huge help on that down payment.
Yeah, and there's not a lot of rules on that program, which is what I like about it. Basically they're looking for it to be a first time home buyer. They require their debt to income ratio to be 45% or less with the proposed mortgage. And they need a 640 credit score. And that's pretty much it.
Got it. I know that one. I know we've got some great plans in Durham. So all you buyers out there, check your specific county as well. There may be monies available to you there.
And the rate's not higher is the other thing. Yeah. Like right now, the rate on that program is 6.25. And generally speaking, on a regular conventional loan, rate's right around 6.25. So there's not a penalty for getting that money.
Hey, Ryan, to that, because that was a big thing that I wanted to talk about. I know you said that there's no other requirements, but there are some out there, right? Whereas a buyer might have to, say, keep a home for a number of years, things of that nature, or have to pay back some or all of the loan. Can you speak to that?
Yeah, absolutely. So the $15,000 is not a gift. It's not a grant. So I always tell my prospective buyers that this is not free money, but as money that you get, you don't make a payment on it. And if you do have to pay it back, you're paying it back at a 0% interest rate. So the way the loan works is for the first 11 years you're in the house, if you were to refinance or to sell the house, you'd owe back all of the 15K. In year 11, they forgive 20%. And each year they forgive 20%. So by year 15, it has been fully forgiven.
And is that for, because I guess there's different programs out there, right? So is that pretty much like across the board?
No. So another really popular one is the Federal Home Loan Bank, which is a similar amount of money. That's usually $15,000 also. The problem with that program is that money is appropriated by the federal government. And each year when that program rolls out, it's usually between February and April, there's a pot of money. And once that pot of money is exhausted, it's gone. And then what happens is people like me find prospective buyers. We register them for that money. They've got their place in line. And then if they don't end up buying or they're not able to fulfill it, then that money does become available again. But that program ran out a couple of years ago in 44 days. So I'm not able to pre-qualify somebody and feel confident that I could get them that money in that very short a period of time. So it's just an unrealistic program because of the pot of money is too small.
Got it.
That's one of those places where I want to say preparation beats timing every time. We can think about, okay, we're going to wait on rates to do this, do that. We're going to wait on prices to do this, do that. But here, beginning of the year, January, February, if you reach out to one of us and then get in touch with the lender like Ryan to start that process, so when that money's available this spring, you're ready to strike. That's so important.
Right. I have one more question to it, Ryan, because I know here in Charlotte, that's, a lot of talk is around the down payment assistance and utilizing it, taking advantage of it, et cetera, especially for like, I guess, first time home buyers or what have you. Can a buyer utilize more than one program at a time and basically stack on top of each other?
Yeah, absolutely they can. So like if it was here in Raleigh, you might be getting that down payment assistance, that 15K, and then stacking City Raleigh second on there. And if it might be House Charlotte if you're in Charlotte. So you can stack those things. In my history of doing loans, I'm not big on stacking them because you got multiple sets of rules to follow to get that loan to the closing table. And it complicates it. And when I have a realtor give me a contract and I've got 25 days to get it closed, I need to make sure it gets there on time. So I don't really focus on stacking those DPAs because I like to get them to the finish line on time. So it's there. There's a lot of people that do them successfully, but there's a lot more nuance to it when you've got multiple sets of rules and multiple agencies that have to approve it in a specific period of time.
Ryan, you just mentioned something that I want to talk to our buyers about is what I call all the gears that have to fall in place to make a transaction happen. And we've got so many people that are looking for that lowest rate, the ease of application. It is so important, in my opinion, to have a local boots on the ground lender in your area helping you through your transaction instead of somebody that's in another state or across the country, doesn't know our rules, in a different time zone, just all the little things that can happen that we need that local lender to get you through to the finish line.
I would love to tack onto that. I feel like we're like a team, right? And it's like you don't financially benefit from doing a transaction and choosing me as the lender or having your borrower choose me as the lender. But what you get is a team. We're all kind of moving towards the same goal line. And, I'd add on to that with the closing attorney. I have done thousands of transactions here in the Triangle, and there's just a handful of attorneys that do those transactions. I'm used to pretty much all of them. They're used to me and how I work too. And I feel like I can pick up a phone and call the attorney, right? I'm not some lender on the West Coast or wherever else. I know the people know me. So if things kind of are going sideways, there's that personal contact. I think that's super important that helps kind of motivate and get things to the finish line.
That reminds me of my granddad. He used to say, I like to do business with people I can get my hands on. I can go knock on your door and look at you eye to eye whenever I need to. And that's what I appreciate about Ryan.
Yes.
Ryan, I had one of the questions we were talking about that first time buyer, co-buying. I know we're currently working with a single mother right now who her daughter just started working here recently. So they're possibly going to buy a home together. And also, what about that person that their parents are going to sign with them on that mortgage? Can you talk a little bit about that and how that might help some of our people?
Yeah. So if they're a first time home buyer and they're looking, let's say, as mother-daughter type situation, if they're looking for the down payment assistance, they both have to be occupying the house. So as long as they're both going to live there, totally fine. If you got parents that are looking to help their son or daughter get into a home, that's not going to be eligible for down payment assistance because they're most likely not going to be occupying the home with them. So on that, they would have to front that 3.5% down payment or 3% down payment. It's totally fine. We can use that person's income and assets to help qualify. It would just be taken into their current house payment for the parents and whatever other debts they have in addition to the proposed mortgage. So both of those things can work. They just can't work with the down payment assistance.
Do you have any idea on, say, once a parent does sign with a child to get them in a home, about how long does that loan stay in place? Or typically, how soon should we be looking for that child to completely take over that loan and refinance?
I mean, I guess they shouldn't need to. There's not really a need to. So with a little bit of planning, what I always tell that the ultimate person living in the house is like, hey, that mortgage is going to drag down your parents' credit if they want to go finance something else. Let's say if they decide they want to finally buy that beach house or mountain house. But a way around that is, I tell them, is like, as long as you're making the mortgage payment from your bank account that doesn't have your parents' name on it, and you've made it for 12 months on time, I can exclude that loan from your parents' liabilities if they go to buy something else.
Okay, that answers my question. That's it perfectly. Mm-hmm. Got it.
So I think the only time then that child should be thinking about a refinance is if rates come down enough to where it would actually make sense and help them get that payment lower.
And what is that amount that rates typically need to come down to make a refinance make sense?
It's different for every person because of the loan amount. So if a $100,000 mortgage has the rate go down a half a point, that's not going to be very much money. But if it's a $500,000 mortgage and the rate goes down a half point, that is a lot of money. So, generally speaking, in my mind, I used to think I could save somebody $100, it's probably worth their time. Now, since COVID and inflation, I'm thinking that number's more like $200 a month. That's just my personal mindset of like, hey, how hard should I try to convince this person they need to refinance? But I'm thinking your normal $300,000-$400,000 mortgage, at least a half a point, but probably not much more than that. Somewhere between a half and 3/4 a point, it's going to make sense.
Got it. I feel like I get to talk a lot today since Donald's sick. I'm asking the questions that I think he's asking because I'm looking at it. And that's something for you guys out there, even you existing homeowners. We talk to you about, hey, every year getting new insurance quotes. Might be a good idea also to reach out to your lender to find out, hey, does it make sense for me to refinance? How can you help me? Would that be a good idea, Ryan?
Yeah, so I'm doing a refinance right now, and that client, I'm saving him a lot of money. I'm saving him over $500 a month. But I told him, it's like a little bit of this is a sugar high because your current servicer is escrowing a lot more money each month than they should be. And they'll recognize that when they do their escrow analysis statement, which they have to do once a year. But for right now, his escrow payment's like $1,100 a month, and it should only be like $900 a month. So his payment would come down $200 a month, even if he did nothing. But I'm going to take his rate down from 6.95 to 6%. And it's a little over $600K mortgage. So he's going to reduce his principal and interest payment, and I'm going to make his escrow account correct again. He protested his tax value and kind of won. Nobody's taxes go down, right? But his did. That's because they jumped a lot more than they should have when the reassessment happened year before last.
Hey, Ryan. You had spoken earlier about the interest rates dropping down into the mid fives would make it a little more of an advantageous move for the seller who has like a 2.5% interest rate. And then we talked a little bit about with the parents being on the loan, and it wouldn't make sense to go ahead and refinance that unless the significant drop. With all that being said, and in the media, all the talk about the portable mortgages, can you talk a little bit about what that would look like if we had a portable mortgage where you could carry that interest rate with you?
Well, yeah, I can absolutely talk about that. The number one thing I'll say about that is any loan that's been made, there's a contract out there. That's a mortgage contract, a note with a deed of trust. And no conventional loan is assumable. So I don't think it's possible for the laws to change to nullify contracts that have already been made. So if they are able to do that, it would be on contracts, promissory notes going forward, not loans that have been originated with those 2 and 3% mortgages. So I don't think portable mortgages is going to be a thing, because remember, when I make that loan and I close on it for that client, my bank might be servicing that thing, but Fannie Mae and Freddie Mac are going to be the owners of that mortgage. And then they're turning around and spinning that into a mortgage-backed security. So it's part of somebody's 401k fund. So it's just too many layers to change something that's already been done. So if they rework that part of the financial mortgage-backed securities, that'd be for closed loans going forward, not loans that have already closed.
Okay, so it's fair to say then that these folks that have these low 2% interest rates, this portable mortgage, if it did pass, isn't going to protect those rates.
I don't see any way possible for that to happen.
Speaking of those 2.3, 2.75s, which I have, and the sub threes, instead of portability, what about, being able to assume that loan? And is that something agents should be looking out for as we're showing houses? Should we be reaching out or doing our due diligence to see? I know we've always talked about VA loans being assumable. I've never gone into a situation like that. But what other types of loans might be assumable? And is it really, it sounds good, but is it really something we can pull off?
It's something that can be pulled off, but it is incredibly complicated. FHA is going to be your other big one. It's going to be an assumable mortgage, your government loans. But let's say if somebody has a $300,000 mortgage, they're selling their house for $500,000, that buyer's got to come up with the other $200,000. So that right off the bat is a big impediment. The other huge impediment is, let's say the servicer is, I'll pick on Wells Fargo. Let's say it's Wells Fargo. Well, they have to approve it. And Wells Fargo has a sales force. So generally speaking, that person's got to apply to take on that mortgage, and they have to qualify on their own merits. So most companies aren't really set up to do that from an assumption standpoint. So if you say, Ryan, I've got a client going under contract today, how quickly can we close? I'm going to tell you, hey, give me 25 days, maybe 21 if I got all their stuff. That assumption might take 2 or 3 months. So there's just a lot of extra moving parts if it's going to go that way, because it's going to be out of that servicer's wheelhouse. Some servicers don't originate mortgages, and those are the ones that be extremely difficult. Like Doven Mule Mortgage, DMI, they service for lots of banks and credit unions, and they are not able to originate mortgages. So I'm not really sure how they would do it. So some servicers might be like, yeah, this is theoretically assumable, but we don't have the infrastructure to be able to facilitate that.
Got it. Guys, I know we've jumped around a lot on this video today, but there's so much out there as far as financing, lending, all that good stuff. Ryan, is there anything that we didn't talk about today that you come across that you really want people to know about?
Well, if you're a first-time home buyer and listening to this, I think the big takeaway that I'd like you to have, everybody thinks that applying for a mortgage and having your credit pulled is going to destroy you. It's going to ruin your financial well-being. And nothing could be further from the truth. And if somebody's in a leash right now and it's still got another 9 months on it, let's say, and they're like, I just want to wait until it's time. I'm going to say that's the wrong thing to do, because that credit score is not the only thing that it takes to get a mortgage, right? What is that debt to income ratio going to look like on a $400,000 purchase? Do I have the assets to put down? What's that payment going to look like? So I think getting pre-qualified now for something that you're going to do 9 months from now is a fantastic idea. And I think too many people get caught up on, like, I don't want my credit pulled. And they use that as an excuse to not get the education and figure out the numbers well in advance of wanting to buy a house.
That's one thing I tell new buyers and step-up buyers that I'm working with is, let's get you in touch with a lender 6 months before the ideal purchase time. That gives us time to get a plan. It gives our lender time, even if just a letter needs to be sent to correct something or small changes that need to be made, because the last thing I want is for us to find that perfect house and then you can't qualify for it.
And let's say they do qualify now, no problem, but their credit score is 720. If I didn't pull their credit, I wouldn't know what their credit score is, because what Credit Karma shows us and what my credit report shows us are not the same. So if they have a 720 and they qualify right now, guess what? If they're going to get a conventional loan, I can make their payment cheaper and their mortgage insurance cheaper if I can give them some advice to get that credit score from 720 to 740 or 720 to 760. So it'll pay them back in spades just to be able to figure out, what can I do between now and then to get that score to the highest level possible.
Got it. I hope this was helpful for everybody. If you've got any questions, please reach out to us, put it in the comments. Also, while you're watching this, if you liked it, please like and subscribe. Love for you to do that. Thank you guys for coming out. Looking forward to seeing you next month. Ryan, what's the best way for people to get in contact with you?
I'm still a little bit old school. If you want to talk with me, just give me a call. My mobile number is 919-601-3780.
Got it. Perfect. Thank you.